Hello and welcome to this edition of Hardman Talks. My name is Keith Hiscock. I'm the CEO of Hardman Co, and I'm joined today by Alastair Unwin, who is the Deputy Manager on the Polar Capital Technology Trust. Great to have you here today, Ali.
Thank you very much for having me.
Ali, you joined Polar back in June 2019, but you'd been following the tech sector long before that, hadn't you?
Yes, I'm actually working in investment trusts before that in the tech sector. So I was lucky enough to start my investment career as an analyst at Herald Investment Trust on the smaller cap tech side of things. Then I moved over to Neptune Investment Management, which was then taken over by Lion Trust to launch a global tech fund. And then I moved across to the Polar tech team about 5 years ago, as you say.
So quite a long record. By way of introduction, investors might actually find it surprising, despite the torrent of coverage and interest there's been in the technology sector, particularly in recent years, the Polar Capital Technology Trust is one of just 3 investment companies that specialise in the space, and is by far the largest by market cap. So, Ali, can you tell us about the universe of stocks in which you're fishing? Is it just mega cap? Is it just the US? What do you define as technology? In other words, by buying your fund, what are investors getting access to?
Well, it's an enormous sector, as you say, and we've got a team of 11 technology specialists in the Polar Cap Tech team, which is one of the largest teams in Europe. And we aim to offer investors exposure to the global tech sector. We've got a growth capital or capital growth mandate. And the aim, or the way we do that in the trust, is to try and construct a diversified portfolio around the benchmark, which in our case is the Dow Jones Global Tech. And we aim to offer the best of what the benchmark has to offer, because there are some phenomenal companies, including the mega caps, as you mentioned, in the benchmark. We aim to offer the best of the benchmark, avoid the legacy players, and then a selection of growth technology companies which investors may lack the resources or expertise to discover, analyze, and monitor for themselves. And that's really the approach we've taken with PCT.
So you're giving us a bit of a flavour, but how do you go about choosing individual names for the fund?
Our approach is a growth-focused approach, and it's based on a couple of, I suppose, high-level observations about technology change and technology markets in particular. The first of those is that technology change is non-linear. It doesn't mean revert, which means that value investing has proven very, very challenging in the tech space. You want to be looking for inflection points, for breakout moments, for step changes in the rate of adoption. And so our investment approach, I suppose, is informed by that observation. And that has impacts for all kinds of things, particularly on valuations. If you get a company that has just reached an inflection moment, it can appear expensive, but within a few years, if it can sustain a supernormal growth rate, actually the valuation can become quite reasonable. It's true of margins. Often when companies are investing all of their excess free cash flow in growth, the sort of near-term margins can be suppressed. So that's something we pay quite a lot of attention to. The second observation is, I suppose, particularly to technology investing as a practice, if you like. And that's the idea that hubris is really the enemy of returns in tech investing. The sector grows a lot. The sector is very exciting. There's lots and lots of new ideas and new things happening. But it is very, very challenging to know in advance if a company is definitely a winner or definitely a loser or definitely overhyped. And we think it makes sense to have an approach that really reflects that reality and takes account of that. So that means keeping an open mind, not getting boxed into never investing in X or absolutely loving Y. And this isn't the same as not having conviction, which we do. And we're very, very happy to go to zero weight in companies that we think are on the wrong side of technological change. But I think it sort of behoves us to have the ability to change our mind when the facts change. And that happens all the time in technology, and it happens very frequently, sometimes in more than one direction. The final point is that disruption, volatility, change or rapid change are recurrent features of technology investing. And so the portfolio is constructed with a very strong emphasis on diversification. We have sort of 90 to 120 positions and a big focus on liquidity. And that's part of our risk management, I suppose, as well as our opportunity management, that we want to be able to change our minds and to change the portfolio when the facts on the ground change, which they are doing all the time. We put quite a big emphasis on financial stability and balance sheets. Luckily, in the tech sector, I think it's still the only sector in the S&P that still sits with net cash. The companies tend to be, or the companies we invest in tend to be relatively high margin, tend to generate cash. We don't really go for companies that require lots of capital. So that's another way we try and mitigate risk and thinking about the portfolio.
And what themes are you finding particularly interesting at the moment?
Historically, the trust has been constructed around sort of 6 to 8 core themes, and we allocate between the themes based on the relative attractiveness and valuation and trends within them. Within the last 18 months or so, that approach has been somewhat eclipsed by the arrival of AI, which is not really like another theme. It is almost a sort of super theme, if you like. And we would describe ourselves as AI maximalists, in the sense that we think this is going to change everything. We firmly believe that generative AI is the next general purpose technology, and moreover that it's an example of discontinuous technological change. And if you think of it, there's been a few examples in history where that has happened, where technology has been progressing on one vector, if you like, and then there's been a change and things have changed dramatically. It could be the height of buildings with the arrival of steel. Suddenly we see skyscrapers within a couple of generations. It could be nuclear weaponry. Conventional weapons get more and more powerful over time. Then a nuclear device comes along that's 1,000x more powerful. Those kind of changes are rare and highly, highly impactful. And we think generative AI is best thought of in that context. So about 18 months ago, we introduced something called an AI lens to our portfolio. And that was really just a way to try and explain to investors that we are thinking through all of our holdings in terms, and all of our potential holdings in terms of how they might be positioned in an AI world, which is, we've been very bullish on other themes in the past, including cloud computing and mobile before that. But this one is become very pervasive. AI has become so pervasive very, very quickly.
Okay, you talked a little bit about history there, but can you talk about the history of the trust and I guess for investors, most importantly, its performance?
So the trust started in its current form in 2001 when Polar's founders brought it over, and absolute returns since then have been very strong. I think actually I was checking before, the trust has compounded its NAV at 15% per annum, which is about 1,200% in total since then. And in the last 10 years, it's actually been at more than 20% per annum as we've had the kind of COVID period and now the AI era come to the fore. And it's a great privilege in my job to meet shareholders, many of whom have been investing with us for all of that period, or certainly very long periods, and are very proud to tell you they're in prices. And that's always really, really lovely to see. And I certainly can't claim credit for very much of that period, but we're absolutely delighted to still be carrying the flame for a product and a trust with such a long and illustrious history. In kind of recent times, it's been harder versus the benchmark, and we've struggled a little, as has everyone really, when you've had returns in the tech sector dominated by a small number of extraordinary companies. Thankfully, we've owned more than nearly anyone else of those companies because they are quite extraordinary, and we're in the first quartile versus our peers over 1, 3, and 5 years. Now, we're hopeful things will change and there could be a broadening in the market, but we are investing in the market we have rather than the one we want. And for now, some of those companies, of those mega cap companies, appear fairly well positioned, at least in the early stages, for generative AI. So we maintain pretty big allocations to some of those.
So what would you say to the investor who might make the comment that isn't it too late in the cycles to be buying tech, and aren't they now all overvalued?
The valuation argument on tech has been a recurrent feature, understandably, in the aftermath of the 2000 bubble. And it makes sense that the technology sector has a ability to hype up its returns and people get very excited about it and valuations can move up. But if you look at the data, the sector's generated about a third of global equity returns since 2010, or about 40% of US market returns. And that's been driven by a 400% increase in the sector's earning per share since sort of pre-great financial crisis times. All other sectors together have delivered about 25% earnings increase. So the dominance of tech has been earnings led, which is something that we look to continue actually in the age of AI. As I say, we think we are very, very early in this new AI cycle. Today, we're more allocated to the enablers of that, the sort of infrastructure beneficiaries. And we don't necessarily see tech as a cyclical phenomenon. And actually, we'd probably turn the question around and say disruption is coming. In fact, more disruption is coming. And the question, the onus falls on non-tech managers for how they are dealing with the impact of AI on some non-tech sectors, because AI is coming to and looking to redistribute profit pools quite meaningfully in some non-tech sectors. On the valuation front, we look at the PE of the sector, and particularly versus its own history versus the S&P. And if you look at the S&P IT sector today, it trades on about 29 times forward earnings against the broader market on about 22 times, which at 1.33 or 34 is at the sort of higher end of its post-financial crisis range. But it's not outrageous. If you think back to 2000, we were at more than twice the market multiple in the tech sector. So we're nowhere near there. We're definitely not in bubble territory. And there are two ways of looking at that. One is that we're at a cyclical high in technology, and this is probably a time to take profits. The other way, which I think is very much how we see it, is that we are moving into a new AI era. And it seems reasonable to us that the market is beginning to discount technology's ability to generate the returns and the profits from that era, just as it has done through the internet, just as it did through the electricity era. This doesn't seem completely out of kilter to us. But obviously, when valuations are higher, we should expect more volatility. There will be setbacks to the AI story and to the technology story, partly because we're so early in it that there's not that many data points to confirm or deny it. So all of those that do come down the line can have a very, very big impact. So we're pretty constructive on the outlook here, even with valuations perhaps slightly on the higher side versus recent history.
So the trust is a closed-end fund, which means that the shares that investors buy on the stock market can trade at a discount or a premium to the underlying net asset value of the investments. How does the fund stand at the moment relative to NAV, and what's the recent history?
We're on about a 12% discount versus NAV at the moment. And if you look at our closest peers and much of the sector, we trade more or less in line with them on that basis. And that's broadly in line where it's been with the last 12 months. It's been as narrow as 6 at certain times. And it's slightly perplexing. We've been active in the market buying back stock. We don't hold any privates or liquid assets. So there's not a question of the underlying liquidity or valuation of the portfolio. But it is something that the board obviously monitor very closely.
Some investors might say, why isn't the dividend paid?
The portfolio doesn't generate much income, given our growth bias and given we're investing in technologies earlier in their cycles. And in fact, we almost go so far to say a high dividend yield on a technology company to us is something to be wary of rather than something to look for. Now, there are other investors who take the absolute opposite of that view. But our view is that you have a high dividend yield when the market is discounting relatively limited growth prospects, shall we say. And the fact that you're returning that much capital says that the management team or the board have a limited view of the growth prospects in front of them. So for us, it would seem, I suppose, slightly non-aligned to trying to pay a dividend out of the trust when the underlying holdings, we see a lot of growth and a lot of opportunities for investment.
Finally, Ali, can you summarise what the technology trust offers the investor in this environment?
I think the PCT offers exposure to the most exciting sector in the world, in our view, on the cusp of the most exciting technology transformation of our investment careers. Getting AI right is going to make or break investment portfolios, both in the tech sector and outside it. And we've got a lot of experience in the Polar Tech team and a proven track record of investing in these kind of environments. Our process is built to deal with change and all that goes with it. And of course, past performance can't be relied upon as a guide to future concerns, but we look forward to many more years of strong growth in the portfolio.
Ali, thanks for your time. Thank you for watching. Please don't forget to like this video and join in the conversation wherever you're watching, and we'll see you next time. Thank you very much.